good morning, good afternoon, good evening. This is the Playbook of the Wealthy. Thank you for coming back for another episode. My name is Dave Grant. My co-host is Heather Townsend. And this episode, we're talking about current events. It's the week of tariffs. It is whatever day you want to think it is. We're recording on a Monday, which was supposed to be Black Monday 2.0. We'll talk about how that never came around. But before we go on, we're still in the intro.
No, but it's just perfect. It goes along with everything we talk about. The prediction. Well, they're always like, they get them wrong most of the time. All right, keep going.
That's right. Yeah. Everything got slaughtered today in the stock market. It didn't.
It's another Black Monday. It's another Black Monday. The future is, Okay.
All right. Before we move on, you have to pause the show, pause the recording you're listening to, follow it, subscribe, throw a like, a comment, whatever you want to do. Just make our presence bigger so that we can expand and we can get more people listening to this so that like you, they can learn. We do have a disclaimer because we are a financial services podcast. Thank you, neither and Heather, if I do this. It is a man named Jordan. Jordan, take it away.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
Before we jump in, today we're just having a big conversation about stuff. It's related to tariffs. It's related to how you should be approaching your investing with this. But before we jump in, our podcast is 4 segments. You get to know about us professionally, personally. We dive into content and we have questions. So, Heather, you good?
I'm great. I'm almost through tax season. What's going on in the world is keeping me quite busy too during tax season, but I'm doing great. I just want to get into what we're talking about today. I don't really want to talk about anything else. So I'm going to ask you, how you doing?
I'm great. I got off spring break. I worked a full week. Then I worked the weekend. And then I took this morning off. So I'm all refreshed. I'm good to go.
You ready?
Let's dive in.
Yeah, let's dive in. Can I first state a few facts before we go in? Dave and I are recording this on Monday, April 7th. The futures over the weekend called for another Black Monday. The stock market was going to take a huge crash. As I'll pull up the S&P right now, and I wouldn't call this a crash, would you? Today it's down another, not even 1%. Not even 1%.
I love that it started at -4, and within the space of 2 hours, it had gone positive. I'm like, where's the crash?
Yeah. So, and I'm going to go through examples of how many times predictions are wrong. And I think that's one of the things Dave and I really want to talk about today is emotions and investing, going on predictions. It causes, let's just say it doesn't cause good things. Calm, collected, having a plan, that wins.
It goes both ways. Like when you're giddy in investing, you make as many mistakes as you do if you are terrified in investing. So this isn't just a one-way conversation.
Let's talk about the study.
So we are talking about Daniel Kahneman. He is a psychologist, and his famous study, which a lot of us talk about in our industry, is about loss aversion. So it's relating to money. So if you lost $10, it is more hurtful to do that than it is the flip side of gaining $10. So it hurts more to lose 10 than it does on the positive side to gain 10. When you lose money in the stock market, it hurts way more than it does if you were to just see your money go up.
Let me put it in an easy to understand. I read that study and I was like, what? I'm going to put this in people feel the pain of losses about 2 times as strongly as they feel the pleasure of equivalent gains. It's 2 times you feel the pain of a loss than a gain, which I think is dangerous too, right? Because you're more likely to react when you're losing because it's more painful. But that's when I would say when the market's down, that's when you can make more of a costly mistake.
True. And yet that's the time when people want to make a change. You don't want to make a change when it's going up, because why would I stop something that's making money? I don't want to make a change when nothing's happening, because what happens if it takes off and I lose out on gaining money? But that is the reasonable time to make a change.
Well, and Hartford Funds did a great study that really showed why selling can be the worst decision. Because it's not just, okay, great. If you're selling on the way down and you miss the bottom, I could see you being like, oh, I won. But here's the problem. No one goes right back in at the right time. Let's talk about how costly it is if you miss the timing. So 75% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. So if you don't time it right, 78%, you've lost out of 78% of the best days. Then what happens if you miss the best days? Let's talk about that. If you miss the market's 10 best days over the past 30 years, your returns would have been cut in half. You have $1 million? Nope, you have 500,000. That's painful.
And you just missed 10 days. That was it in 30 years.
That's crazy. All right. If you missed the best 30 days, it would have reduced your returns by an astonishing 83%. You don't have $1 million. You have $117,000. I mean, this is why, like, emotion and investing, I get it. I think it's impossible to not have emotion with money and investing, but you have to look at the data. You just have to. I mean, on that, I'm not going to try to predict when the best days are, and I'm not going to miss them either.
Yeah.
No.
It's so hard when people are like, oh, I'll just wait till the market calms down. Then I'll get back in, then it'll be some good days ahead. I don't know anyone who has figured out, okay, when is the market calm? It never is. And you can never time your position back in, because by that time you realize it's calm. Like we just talked about, you've missed those days. You're not getting that return again.
Let's talk about COVID.
Please.
COVID. Well, that's the latest, like, really sharp downturn. I think the worst decline was about 34% for the S&P, and it went down fast. I mean, they had to halt trading on the floors. People were selling off so fast. It was crazy. Guess when the stock market started rebounding? I had to look. I didn't even believe it when I looked at it. End of March 2020. The world was shut down. That was when we were full on in COVID. Like, everything was shut down. It was starting to recover. Who would have predicted that?
Not people with COVID, I'll tell you that. I'm in a weird mood today. You're going to get some cracker jokes coming out right now.
I love it. You know, one thing though, Dave, that I do want to state for people that are listening, and why I think we talked about the study you brought up on loss aversion. It's not easy to see your portfolio go down. I don't know how much I've lost right now. I don't look. But I've lost money. You've lost money. Our clients have lost money. It's not easy. What's harder, though, is to do the right thing and to not react emotionally.
It is very difficult. One thing I've seen that has worked is when people talk about it. Whether that's with an advisor that they have or with someone who is smart like they are and can have a educated conversation about it, getting those concerns out really helps. I'll give you an example. My client roster is not too huge that I couldn't call 80% of them over the weekend. So I called them. I had 2 clients that were concerned.
That's how it should be, right? Because one thing that I also want to say is, you know, investing, there's a reason the returns are so great based on history, is because you have to be able to ride the volatility. That's where you're rewarded with these great returns. You have to be able to ride these sharp declines, recessions, corrections, bear markets. what if you don't? One of my favorite things is if you do you know anyone who has gotten wealthy just leaving money in a bank account?
No, well, the bank, but no one else.
No, the bank made money off of you, right? Yeah, you're right. They loaned it. They loaned your money to someone else or invested it in something else that made them a ton more money, right?
Exactly.
And I had to look this up because the headlines too are just, I mean, even going into the stock market today, the headlines were crazy. But recession predictions and headlines get it wrong all the time. I'm going to throw out some funny ones. Okay, in October 18th, 2021, the New York Post insists US has dipped into recession. Well, that was wildly wrong, wasn't it? Bloomberg asks in October 2021, is the US already in recession? The answer was no. I have a slew. Okay, February 2023, or no, March 2022. Goldman Sachs warns Russia's war on Ukraine could plunge US and Europe into recession. That didn't happen either. I have a slew in our Google Doc, like a list of how many titles have been wrong, how many news headlines have been wrong on these recession predictions. I think that it's human behavior that we want to predict because it makes us feel like we have some sense of control. And I get that.
Agreed.
I get it. I totally get it. But we don't. I'm just going to say that. We only have control of what we do with our money and our own actions. And listening to all these headlines and trying to create predictions, it gets you in some dangerous territory.
It does. I mean, if you were 18 years old and you said, I'm going to go to college either to become an economist or a weatherman, I think I would laugh at you in your face. Those are the two jobs you get to guess for a living, are wrong all the time, and you get paid really, really well.
Fascinating.
I'm like, what's the point? Like, all these big banks coming out, we're in recession. I think it's going to happen in 2 months based on our data. Okay, cool. Let me know when we're there.
But let's give an example.
And they get it wrong then too.
I mean, the facts are, we can deal with facts that are true. We're going to have another recession at some point because that's an economic cycle. We've talked about this. It's just a matter, it's not if, it's when. And so you plan for it. And if this turns into a recession, we've planned for it. You have emergency reserves. You don't have high credit card debt. You have cash and fixed income. If you are already in retirement, like, we plan for these things because it's not a matter, again, of if, it's when. And if this is a bull market, it could happen for a few years. We plan for that.
I think one of the fun questions to ask, not fun, I mean, this whole situation isn't fun, but one of the telling questions to ask people when they start talking about this is, well, when did you need all that money? I haven't heard anyone say, I need all of it tomorrow. But none of them have said that. It's, oh, I need this in like 20 years when I retire. I'm like, awesome. So let's write this out. Like, you're not pulling it all out tomorrow anyway. So why would you pull it all out now when it's worth less? That is a really bad choice. And even if you're close to retirement, you don't need it all day one. You just need day one's expenses. And hopefully that's in cash. If it's not, let's have another conversation. But you do not need all this money tomorrow.
No, I think that's a great point. You know, someone said, I think it was the Wall Street Journal, wrote a great article over the weekend that I was reading. And I forget who says this quote. You might know, or I'm about to Google it so I can give them credit. But one of the costliest quotes in investing is like saying, this time is different. Sir John Templeton said, the four most dangerous words in investing are, this time it's different. And I thought about that. And I was like, it's so true, because COVID was unprecedented. The dot-com bubble was unprecedented. The Great Recession was unprecedented and different. Every downturn, I would say, has been different. Have any of them been the same?
No. I mean, I started working in '07. And so I was 6 months in when I saw people coming in. It was '08, and people were crying, coming in the door. I could hear them crying through the door. I was the receptionist at this point. I was no one. And then they would cry on the way out. I'm like, what on earth did I sign up for as a job? Like, I don't know if I can handle more tears than that. That's how you start to realize this is a lot. Like, there's no wonder people are feeling this emotion, and they're feeling, okay, I went through, the .com like in the 2000s, and like you said, this time it's different in '08. That kind of was different. Like, that was systemic crisis of things breaking. But you fast forwarded 3 years, you were all the way out of that. Things fix themselves, and the stock market just goes back up again. It may take a little longer when things break a little harder, but if things break indefinitely, the world's over. Like, there's no going around that. If things break, your investments are going to be gas, water, and the goodwill of your neighbors. So things aren't breaking.
Well, and fear is like when the worst financial decisions are made, in my opinion. You can't make decisions out of fear. And that's what I've said to my clients. They're like, I'm like, okay, let's say this time is different and the US goes to, we crumble. I'm not saying that's what I think is happening for anyone listening, but I'm saying worst case. Let's play out worst case scenario right now. You are exactly right. We got some way bigger problems in our retirement accounts and our investment accounts.
Yeah, we become like, it's like South American countries and South African countries where their inflation is through the roof and they're printing $1 million bills. Like, there will be some huge problems at that point that we're far away from. So I think fear it's okay to feel. It's not okay to act on.
Great way to put it. I was actually on a call with BlackRock to give some people some comfort in this time. The interesting thing is corporate and individual balance sheets are relatively healthy right now as we're going through this. Like, they're actually in history relatively healthy. So that means we can ride some storm. That's comforting. We're more prepared for if we go into a recession. Okay.
Talking about fear. One more thing.
Yeah.
Listener, if you're at a computer, pull up the S&P 500 chart over the last 5 years. The time, and this goes back to the Warren Buffett quote, be fearful when those are greedy and greedy when those are fearful. If you look at the chart, everything looks normal until the start of 2024. That trajectory from the start of 2024 up to, 2 weeks ago, that was a steep climb that rarely went down. The amount of greed that there was at that point, because people were so happy about getting rich, that is the time to get a little bit scared, because there's going to be a downfall of that. Was I predicting it? No. But things do not go up forever. They have to come down. And you have to go through that cycle of, okay, we're in a booming economy. Guess what happens after a booming economy? It shrinks every time. Out the 100 out of the last 100, it has happened. So this isn't no surprise. It's just a surprise of how quick it happened.
All right. I think one last thing I want to say before we talk about what you should do.
Okay.
The stock market's efficient. It is. Okay. Let's provide some facts. Since 1947, there's been 14 bear markets. There's going to be some more too. The average length of a bear market is only 9.4 months. It's actually shorter than I thought. The average.
So bear is bad for those listening, right? Bear is bad.
Yeah, bear is 20% down from all-time high. Okay. And the S&P hasn't hit it yet, unless it's hit it as we're talking right now, but it had not hit it as of Monday morning. Okay. The average length of a bull market is around 2.8 years. That is that the bull market lasts 3.5 times longer than a bear. That's ridiculous. 3.5 times longer. Take some pain, like short-term pain. Let's just say a year, few years for like 3.5 times longer of gains. Like that's amazing. It's beautiful.
Yeah, I mean, thank you for listening to us ramble, because I feel like we talk about a lot of this stuff and we talk different things to each other versus our clients. Because between the two of us, I think we know that we practice what we preach. We're not emotional with our clients' money. We're doing this based on rules, based on agreed upon procedures that we have. But then we talk to clients very differently because this is a personal relationship. And we know that they necessarily don't care about all the rules and procedures. They care about what they're feeling. So to the listener, thanks for letting us ramble and just talk about it.
I did want to share this funny text that I got today from one of my advisor friends. Because today's been crazy in the stock market, just like all over. And to go back to what you said of how like I'm very calm and collected with my clients' money, similar to you. I chose to not really trade today because it was just too volatile. And this is a great example. Heather, what is happening? I literally was about to sell off a small cap fund to tax loss harvest, and it's up 5% in the past minute. Like I'm like making my kids breakfast, read this text, and I'm just like hysterically laughing. I'm like, yep, not trading today, because if in 1 minute something moves at 5%, it's too big of a spread. You get up like low and it goes up 5 and you just lost 5% upside for your clients. Like, no, thank you. It's going to be okay. We've seen this before. And Dave and I are here to guide you on what we're doing with our clients. We're going to talk about it right now and recommend what you should do. So Dave, take it away. You made a list.
All right. So there's 4 things. And it's pretty much, some general rules, but also some things right now if you're not feeling the greatest. So as we get out of this period, you should be understanding that investing is rules-based and not emotion-based. So you should be setting up to say, okay, if my portfolio shifts a certain way and it becomes too aggressive, I need to sell some things that have grown and buy some things that are not doing so well. So it's rebalancing. And you just follow rules. You should not be getting emotional with your investments. It's very difficult to do. Not many people can do it. But you should not be doing things driven by emotion.
I also think this is a great test for those who have not experienced loss in their portfolio before. You need to experience loss to actually know what loss feels like. But I do think sometimes people who have, especially in the last 2 years of 20 plus returns, maybe got very aggressive in their portfolio and that greed came in a little bit.
Mm-hmm. Yeah, emotions run both ways. Like you can be fearful of your investments and you can also get really giddy about it. And you can start to make bad decisions on both sides.
Mm-hmm.
So that kind of goes into the second part of if you're going to change your portfolio, like if you're feeling it's too aggressive right now, don't make the change today.
Yeah, no.
Let's get through this period and get to a calmer point, and then you make a change. And do it when you feel no emotion. Do it when it's part of that to-do list. You weeded the backyard, you cut the grass, you rebalanced your portfolio and changed your allocation. Now you have to go to the store. It should just be like that. It's boring. It's rote.
You just made that sound so exciting. Not.
It should be that exciting.
I know, it's true. It's true. Okay.
All right. We said it before. You don't need all of your portfolio tomorrow. So why would you liquidate your whole portfolio tomorrow and take it in cash? So yes, it's just fear driving you. And that's okay. But if you need money tomorrow for living expenses, then you might need to sell something. You probably should have planned for that a little bit better. That's kind of on you. So if you're retired and you need income, you probably should have cash. You should have short-term investments to fund that cash when it runs out. It shouldn't all be equities.
This is exactly why people who are living off their portfolios are not 100% equities in their portfolios. This is a great, great example why you're supposed to get more conservative as you are getting closer to retirement or retired or in financial freedom.
Mm-hmm. All right. This is for the person who is losing it right now. So if you cannot not do anything, like if you have to sell something in order to sleep tonight, then do it. Like this is just investing at the end of the day. I don't want it to keep you up at night. So if you have to sell something or sell everything, understand that you are making that decision. And it's okay. Park that money. Put it in a 3-month CD. At the end of that 3 months, you are going to invest it back in the same way in your portfolio as it is now. Unless you decide to change your allocation. You are not allowed to change your mind. So it's 3 months, you're going back in. Remember, it's rules-based. It's boring. You cannot say next week, things look better, and I'm going to reinvest. It doesn't work that way. So no earlier, no later than 3 months. Our advice is always, you should be in the market. Downturns should not affect your decision. And I've had someone say, I can't do this, and I'm going to go against your advice, and I'm going to sell everything, and I want it in cash until I say it's okay to get back in the market. It's like, great, do that. But we're not working together.
Good job.
It's very difficult because it's emotion driving it.
And I get it. I don't want my clients to be worried to reach out to me at all. No, that's what we're here for. Absolutely. Please reach out. But I wanted our listeners to hear that, yeah, the going all cash and that number 4, like, I think it's a great point. Then do it if that's the only way you can sleep at night. But yes, I couldn't continue to work with someone like that because you went against everything that I know that we just talked about in this podcast today. The data and the facts says completely otherwise, unless you can promise me that somehow you know something that no one else knows is what tomorrow is going to bring.
I think there's a trust issue too. Like, imagine if you were going to your doctor and you're saying to your doctor, like, is this the right surgery for me to have? And he's like, yes. He's like, great, I'm not doing it until I say it's the right time for me to do it. If that surgeon said, okay, just let me know when you're ready, that is a malpractice lawsuit waiting to happen. I think it's the same on our side. My advice is going to be the same for everyone. You don't need this money tomorrow, so do not pull that money out tomorrow. Wait until your emotions have calmed down and let's talk about it again. Because it's emotional on both sides. Like, it's emotional for us as advisors because we care about people and we see they're going through a hard time and we don't want you to make a decision you'll regret later. So that's why we're saying don't make a decision now.
And I think what I want to end with, Dave, and you said it most beautifully, it's like, weirdly enough, I actually do get excited during these times. I mean, not for people losing money or hard times or anything like that. You
sadist.
No, but in the sense of this is when, if you make the right moves during these hard times, they can greatly even multiply your wealth.
We have a question section called What Would You Do? My husband and I are retired. Our income is taken care of through Social Security and an annuity. However, he can't sleep when our portfolio takes a dive, whether big or small. What can I do?
I'm wondering if it's the husband doesn't understand how the stock market works. I did have a client come to me who just had never been walked through how dips in the stock market were normal. They had been in bonds most of their life because no one sat down and actually educated them with honesty about the stock market. Once you show a chart of how since 1900 and pull it out, I mean, if you look at the stock market in just even a few years, it looks crazy. But if you pull it out 10, 20, 30, 40 years, it kind of is a pattern. If they can't get over they don't even need it though. They don't even need the income. So why have a portfolio, I guess? And if you can't sleep and you can't enjoy your money, go cash. Put it in some CDs and high yield savings. I mean, you've made it. You're retired. If you don't want to grow wealth, you're happy. And really, if I ran through all my scenarios and everything looks 80, 90, 100% probability of success, go cash, give it away, whatever. What do you think, Dave?
I actually just had a meeting with a lady like this. She had retired and her parents just passed away at the same time. So it was a pretty traumatic time of lots of life events. But she had enough cash where she could live on for the rest of her life. She didn't need to invest it. So now it's a case of you can be in cash. So if your husband here wants to be in cash, and then wants to see what it's like to gradually get back into the market over time, you can do that too. Like, I mean, as you said, you've made it. You've reached the end of the line here of your income's taken care of. You don't need any more. And if you do, you got some cash. You don't need to play this game anymore.
Or do the 50-50 approach, my favorite approach that literally seems like, let's agree. The 50% is in cash for the husband, the 50% of cash is in for the wife, and that's how it is. Compromise. Okay.
There you go.
Question 2. I'm looking to retire in 2 years, and with the tariff news, my portfolio fell by over 10%. 10%. I can't recover from this in 2 years. What is your advice? Can I retire on time?
That is a big deal. Okay, first of all, who says you can't recover in 2 years?
That's what I thought.
Maybe you can. It's only 10%, which means you need to get up 20% in 2 years. Definitely doable. But this is where you need to do a couple things. One, run your retirement scenarios again. What happens if you retire in 2 years and you don't recover? What do you need? Was the number that you were shooting for, your minimum amount? If that's the case, yeah, you may have to adjust your retirement scenarios. But if you had some surplus, maybe this just brings that surplus down a little bit. Maybe retirement is not as, don't have as big cushion as you had before, and that's okay. But then you also need to start adjusting your portfolio. Because if you go into retirement and we have another sharp downturn, yeah, that's going to hurt even more. So you need to start insulating yourself with first couple of years of income in cash. Then you need some short-term investments to refill that cash, and then the rest can be equities. But you could still be fine. All right, question number 3. My partner and I have a cash surplus and invest it into our portfolio like clockwork every month. Should we be doing anything different during severe market dips like we're experiencing now?
I mean, this completely depends on your risk tolerance, right? I would say if you have extra cash laying around and you have a long time until you're going to need this money, maybe buy when it's low. Even if it's 10% down, it could still go lower, but you're kind of locking in already a 10% discount, right? But otherwise, I'd say no. Stick to your plan. Stick to what you're doing. Don't change anything. That's kind of where I'm at.
Mm-hmm. I always like to throw this question back. I'm like, okay, when the market was up 20%, were you doing anything different then when things were more expensive? And they're like, they're like, then no.
I am the same thing. I am one though that I buy when it's down. Like I do buy more. I don't wait to dip, but it's kind of the saying of like, I take care of myself last, I take care of my clients first. So, I have automatic money going into our brokerage every month, but I trade all of my clients before I get to myself. Just like I haven't prepared my tax return yet, right? All my clients' tax returns are prepared, haven't prepared mine. Okay. So, but on Friday, right before the market closed, I'm like, oh, I haven't invested our cash in a while. And I did, because I was like, well, it's at a discount. I don't need this in the short term. So might as well buy at a discount. No emotion.
You were the one who stopped Black Market 2.0 happening by swinging the market with your cash investments.
Oh, yeah.
All right, we're going into our final section of our podcast. It's called Highlights. This is our personal wins or personal highlights for the week, where you get to know each other personally.
I have such great news. So last year during tax season, I went to, I think it's Antigua, I have learned, not Antigua. And I worked a lot. Kids would nap. I'm on the computer. I mean, I worked probably 4 hours a day. And this year during my vacation, I didn't take out my laptop except when I was on the plane.
Oh.
It was amazing. I had such a great time. I'm really happy with hiring Lisa. She's doing great. I'm grateful. And I think you don't know it's working until you actually test it. And, I'm definitely in a better place than I was a year ago, and able to kind of unplug it was really just 3 work days that I unplugged because of the weekend and everything, but it was really nice. And it's just great to see my kids and be present and have those memories. So I'm really grateful. And then just like you came back and I've hit the ground running, but it's like you're rejuvenated to give your best to your clients because you just took a few days. It's so needed. It's so needed. And yes, I worked the weekend and all the things, but it's like, I don't care because I took 5 days off. Right.
Mm-hmm.
So that's
agreed.
Yeah. How about you?
All right. So my highlight, we were in LA for spring break. It was a bucket list of one of my kids because they just wanted to go across the country. And when you're in a city for 6 days and you realize that your family likes beach vacations, that's a hard pill to swallow. But we did see the beach. We were down in Santa Monica and Venice. But then we did we did a bus tour. Actually, we did 2 bus tours. But on one of them, I saw a celebrity walking down the street, and I was the one to pick it out, and the driver didn't even see him. Do you want to know who it was?
I, of course, want to know who it was.
You're not going to know who they are.
How do you know that? How do you know that already, that I'm not going to know who this is?
It's a very niche actor.
Okay.
And the only reason I know it is because he's British, and me and my wife watched the movie The Holiday a lot.
All right,
so his name is Rufus.
I'm getting the Google.
His name is Rufus Sewell. He was Jasper in The Holiday. He's like the managing editor that follows her to LA.
Okay, if these people are listening on YouTube, you need to put up his picture. Once I see his face, I'm like, oh, yeah.
See? Mm-hmm. So that was like, I saw his face and I was like, I have no idea what your name is, but I know who you are. And then I started frantically texting my mom. So I'm like, you know who it is. He was in The Diplomat. He was the husband. And she was like, he was also in The Holiday. And I was like, so we were very excited on the bus.
Oh.
But it was kind of cool when you see someone that you just watch on TV just walking down the street past a gas station. It was bizarre.
And you had a great time?
Yeah, we did. We were there 6 days. I think that was too long just because we were in 2 hotel rooms and it was like, we could have done all we did in 4.
You have older kids and I always wonder, I mean, my husband and I love to go to cities, but I do think kids just have more fun at the beach. But I thought it would change as you get older, but apparently not.
I mean, we even did a tour of SoFi Stadium. Like, they're both huge football fans. I'm like, okay, this is going to make your vacation. And they were like, yeah, it's okay. I'm like, come on. Okay. But they had the most fun jumping in the ocean that was 60 degrees. I'm like, it's freezing. I'm like, we don't care, Dad.
Good for me to know. Many more resort vacations on the beach in my future. Got it.
Alrighty. So, thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts, and the video version of the show is on YouTube, Instagram, and LinkedIn. If you want to email us at the show, you can contact us at hello@playbookotw.com. And we'll see you next time.